The Dow tumbles more than 700 points, and fears are now starting to pick up with the new Trump tariffs going into motion. But it wasn't just the Dow with a big move. We had the S&P 500 down 1.71%, the Nasdaq down over 2%, the Russell down nearly 3%, crude oil tanked, and gold came down from recent highs. With a tremendous amount of names down over 5 and 6%, United Healthcare taking a 7% hit in one single day. Now, it's definitely a risk-off appetite as we're looking at MicroStrategy's down 7.5%, Coinbase down over 8%, Hood down 7.9%. Could it be profit taking? Could it just be merely a pullback? Let's get into what exactly is going on. This week was a very busy week of news, and I just want to break down a few main items that I personally saw here. US consumer sentiment has plunged over tariff and inflation fears. Now, for me personally, sentiment is just as important as anything else. If the consumer slows down on spending because they're concerned, well, this is going to impact GDP. This is going to impact companies' earnings. So consumer sentiment is definitely a massive trigger. While the fear and greed index is sitting at a low of 35, we're not quite at extreme fear right now. And I actually think there could be some more downside risk here. The market's been due for a healthy correction, and there are some things taking place here. The put and call ratio is still in a greed state of mind, and market volatility is actually neutral at this point in time. We haven't seen a massive spike in the VIX, but what we are seeing is that the VIX is starting to break out from a major 50-day moving average here, which could be signaling a little bit more fear coming into this market sooner than later. Now, while all this is taking place, probably the best timer of any market crash is definitely Warren Buffett. This guy always has the cash at the right time, whether you want to talk about the dot-com bubble where he held 70% cash, whether you want to talk about the financial crisis where he bailed out banks, and whether you want to talk about right now where he is sitting on record cash, ready to make some big deals in my personal opinion. Now, while Buffett has amassed over $339 billion in cash, we are seeing the Buffett indicator trading extremely high at a 211%. This is over a 66% overvaluation when we compare GDP to the US stock market valuation. Unemployment has remained very strong, but it is ticking up from recent lows of 3.4%, now pushing to about 4.2% is what we've seen. And when unemployment ticks up, it usually happens pretty fast as we've seen in the past. And this is going to be the signal for me for a confirmed recession if we do have a recession. Now, I'm not saying there's going to be a recession, but I'm saying this is definitely something we want to keep an eye on if we see a spike in unemployment. Done tremendous videos on the employment picture. A lot of employment has come from service-based jobs and government-based jobs with a gig economy, meaning that I can create about 3 jobs from the comforts of my home, driving everything from Uber to Uber Eats and Lyft and many other apps that are service-based that contribute to this gig economy I'm talking about. Along with that, there's been a tremendous amount of fiscal spending, creating government jobs that I just don't think are long-term. So as inflation heads back up to 3%, something we've talked about that inflation is going to be stickier, this is causing concern with the consumer. And what did I just say? The gig economy is heavily reliant on the consumer creating jobs. If the consumer stops going out to eat, if the consumer stops traveling, if the consumer stops spending their money, this will collapse the gig economy and will spike, in my opinion, unemployment. And that has been the biggest concern that I've had with this gig economy that we've had for an extended period of time. Now, of course, the DOGE stimulus checks could absolutely help this gig economy thriving a little bit further, but I just don't know how sustainable it is to keep mailing checks. We are running substantial deficits here, and in my opinion, I think all this money that the government is finding should be put towards paying down our deficits because the interest is just astronomical. The other problem is mailing out $5,000 checks could create even more inflation, and I just think they should avoid that going forward. We all know when we got stimulus checks, it caused mass inflation because the first thing the consumer does is immediately spend those checks, leaving less goods out on the market with too much money, forcing prices to go higher. So Buffett keeps hoarding cash, markets keep climbing higher, and we've recently had an interesting pullback. So let's take it over to the charts. Now, as the market's making newer highs, as most of you know, my 2 largest positions are fairly defensive with Vici Properties and Pfizer. Both actually performed pretty well here. We're starting to see high flyers sell off, and we're starting to see defensive names now get a bid. Everything from Conagra Brands to Pepsi rallied pretty hard this week as inflation ticked up and there is a flock to safety. Now, the trend line that I'm personally using here is a 90-day trend line. And why do I use a 90-day trend line? The 90-day trend line, in my opinion, is possibly the most important one because this gives us the catalyst of earnings. Every 90 days we get earnings, and I think those are the most important things that move the market. Are companies growing or losing their earnings, and how is the market reacting to this? And so this 90-day trend line, as we can see, has been a beautiful line of support going up to recent highs. This is a 1-year chart we're looking at. And so the only thing I want to do is draw a line that I've talked about numerous times here. On the SPY, we're looking around 606. And on the S&P 500, we're looking around 6,100. But take a look at how many times we've had a hard time breaking above this trend line and maintaining that upward trajectory. As many times as 1, 2, 3, 4, call this resistance at 5, 6, 7, 8 times we've kind of gotten rejected from this trend line here. Now, so there seems to be a tremendous amount of overhead selling when we get to these levels. And now we're going to be really testing, in my opinion, a very important trend line here at the 90-day moving average. If we break below the 90-day moving average and have a substantial move below, I do think we could be looking at a reversal of market conditions here. Maybe it's best to stay in those value names that have been outperforming, like your consumer staples and healthcare that pay dividends and have pretty resilient earnings. But something is definitely up with this market as of late. The other thing I want to talk about is GDP has been kind of coming down here. Now, it's still strong, no doubt about it. But if we see that unemployment make a move, as I've been talking about, if the consumer is concerned, we're going to see unemployment spike up. And maybe the market's getting ahead of this. But even if it's not, valuations are still pretty elevated and the Buffett indicator is definitely flashing red. But the thing I want to point out is we've been getting over 2.4% GDP readings pretty consistently. And this is going to be and the next couple quarters are going to be an actual test on GDP. Can we maintain this strong GDP growth? We're projected to do 2.3% GDP. This was recently updated by the Atlanta Fed on February 19th. But we're also starting to see concerns with inflation. So it's a pretty interesting domino setting up here that I wanted to point out to everybody. We have Buffett still hoarding cash as his indicators are flashing red, as consumer sentiment plunges over tariff and inflation fears, while markets are trading at record valuations. We're going to have GDP readings that I believe are going to test the markets here. You know, we've really seen GDP over 3% pretty consistently, and now we're talking about 2.3%. Now, I don't think a lot of this inflation has anything to do with Donald Trump at this point in time. The man just got in office. I always said that this inflation was going to remain elevated for a lot longer than we all anticipated. And while the ride down was really nice and stocks rallied off of this, I do think the last few miles are going to be brutal. And I've said that the end of this year could be a very difficult year. I'm sticking to my guns on this, guys. And as most of you know, the way I'm investing is very contrarian. I'm not picking the high flyers. I'm picking names that I think could outperform because the valuations are just so depressed. As always, this is just my opinion, and we will see you all in the next one.